You're choosing Vanguard. You think it's the safe move. It feels rational, low fees, diversified, proven. But you're ignoring something. Something that won't show up in the first year or the second. It shows up around month 14, when nothing's changed, when your balance looks almost the same, when real estate investors around you are talking about equity and cash flow, and you start wondering if you made a mistake. That's when the damage happens, not in the returns, in your head. You'll convince yourself you're being patient, but you're actually just waiting for a reason to quit. And you'll find one, right before the part that actually matters. There's one factor you haven't considered yet, and without it, you won't make it to year 3. The real problem isn't the choice. Most people frame this wrong. They ask Vanguard or real estate, which returns more, which is safer. But that's not the question that determines your outcome. The real question is, which one will you actually stick with? Because wealth isn't built by the best investment. It's built by the investment you don't abandon. And here's what nobody tells you. The version of you that exists today, the one making this decision, is not the version that has to live with it in 18 months. Future you will be tired, bored, doubting. Future you will see your balance stuck at 103K while your coworker talks about a duplex that already paid for itself. Future you will open the app and feel nothing. No progress, no wins, no proof it's working. That's when you'll start looking for exits. The boredom phase. Every investment has a boredom phase. It's the period where nothing visible is happening. The numbers barely move. The excitement is gone. The conviction fades. For Vanguard, this phase hits around month 12. You've watched your portfolio go up 4%, then down 3%, then up 2%. You've made maybe 4K on paper. It doesn't feel like wealth building. It feels like waiting. And while you wait, you're getting targeted ads for real estate courses. You're seeing Instagram posts about mailbox money and passive income. You're hearing stories. Everyone has a story. Someone's cousin bought a rental and it's worth double now. Someone's neighbor quit their job. Someone on YouTube retired at 37. And you're sitting there with your Vanguard account wondering if you picked the boring path. This is the trap. Why Vanguard feels like a mistake before it pays off. Vanguard doesn't give you anything to do. You deposit money, it invests automatically. You check it once a month. Nothing's changed. There's no progress to show. No projects, no renovations, no tenants, no deals. Just a number that moves slowly. And human brains hate that. We're wired for valuing action, visible effort, tangible results. Vanguard gives you none of that. It asks you to do the hardest thing possible. Nothing. Just wait. And waiting feels like losing, especially when you're comparing yourself. The comparison trap. Your real estate friend is posting updates. New property, equity increase, refinance, cash out. It sounds like momentum. It looks like winning. Meanwhile, your Vanguard account summary looks identical to last quarter. You're not losing, but you're not winning either, at least not in a way that feels real. So you start reverse engineering the decision. You think, maybe I should have taken more risk. Maybe passive investing is for people who don't care. Maybe I'm missing out. This is loss aversion talking. You're not afraid of losing money. You're afraid of losing time, of being wrong, of looking back in 5 years and realizing you should have done the other thing. That fear is stronger than greed, and it makes people quit. Why real estate feels like progress, even when it's not. Real estate gives you tasks. Find the property, make the offer, close the deal, manage the tenant. It feels like building. Every action feels like progress, even when it's not. Even when the roof needs 8K in repairs, it still feels like you're doing something. And that emotional reward keeps you in. Vanguard doesn't give you that. It's silent, passive, invisible, and that invisibility becomes unbearable. The impatience window. Here's what actually happens. You start with Vanguard, you're confident, you've read the studies, you trust the process, but around month 14, something shifts. You're not seeing the results you imagined. You thought you'd feel different by now, richer, smarter, more secure. Instead, you feel the same, and the doubt creeps in. You start researching alternatives. You watch real estate YouTube. You run the numbers on rental properties. You convince yourself you're just exploring options, but what you're really doing is preparing to quit. You're building a narrative, a justification, a reason to say Vanguard wasn't wrong, but it's not for me. And the moment you create that exit, you've already lost. the real cost of switching. Switching investments doesn't just reset your balance, it resets your conviction. And conviction is the only thing that keeps you invested long enough to win. Every time you switch, you start over. Not just financially, emotionally. You have to rebuild belief, rebuild patience, rebuild discipline. And most people can't. They switch from Vanguard to real estate, then from real estate to crypto, then from crypto back to index funds, each time thinking this time it'll feel different. But it never does, because the problem isn't the investment. It's the part of you that expects it to feel like winning before it actually pays off. What you're really asking. When you ask Vanguard or real estate, you think you're asking about returns, but you're not. You're asking which one will keep me interested, which one will give me proof I'm on the right track, which one will feel like progress. And that question is more important than IRR, because if you quit, none of the math matters. You could pick the better investment and still lose, just by leaving too early. The missing factor. There's something neither Vanguard nor real estate can give you. Something you need more than diversification, more than leverage, more than tax benefits or compound growth. It's the thing that determines whether you're still invested in year 5 or whether you've already moved on, chasing the next thing that feels like momentum. And until you understand what that factor is, you're not making an investment decision. You're making a bet on which mistake you'll quit slower.
The factor you're missing isn't tactical. It's not about choosing better assets. It's about understanding feedback loops. Every investment has a feedback loop. It's the time between action and reward, and that loop determines everything. Real estate has a short feedback loop. You buy a property, you see equity. You collect rent, you feel progress. The feedback is immediate, visible, tangible. Vanguard has a long feedback loop. You deposit money, nothing happens, months pass, still nothing. The feedback is delayed, invisible, abstract. And here's the problem. Your brain isn't wired for long feedback loops. It's wired to quit things that don't give you proof. Why your brain betrays you. Humans need evidence. We need to see that our actions are working. Without that evidence, we assume we're failing, even when we're not. This is why diets fail, why people quit the gym, why New Year's resolutions die in February. The feedback loop is too long. You work out for 3 weeks and see no visible change, so you quit. Not because the strategy was wrong, but because your brain didn't get the reward it expected. Investing works the same way. Vanguard asks you to invest for a decade before the real compounding kicks in, but your brain wants proof in 6 months, and when it doesn't get it, it panics. It tells you to switch, to try something else, to do something. That panic is what kills your wealth. The compounding gap. Here's what nobody explains clearly. Compounding doesn't work in a straight line. It works in stages. Stage 1, the accumulation phase. This is years 1 through 5. You're adding money, your balance is growing, but most of the growth is just your contributions. The actual compounding is invisible. Stage 2, the boring middle. This is years 6 through 10. Your contributions start to matter less. The compounding starts to matter more, but it still doesn't feel dramatic. You're making progress, but it's slow, unremarkable, easy to ignore. Stage 3, the acceleration phase. This is years 11 and beyond. This is where the compounding becomes obvious, where the growth starts outpacing your contributions, where you finally see the math working. But here's the cruel part. Most people quit in stage 2, right before it gets good. The quitting curve. There's a pattern to when people abandon index funds. It's not random. It happens in 3 waves. Wave 1, month 6 to month 18. The excitement wears off. The balance looks flat. People get bored and leave. Wave 2, year 3 to year 5. Life happens. A car breaks down. A medical bill hits. A job changes. People cash out because they need the money or because they've lost belief. Wave 3, years 7 to year 9. This is the most painful one. People see a market correction. Their balance drops 15%. They panic and sell. right before the recovery, right before the acceleration phase. If you quit in any of these waves, you lose, not because the investment failed, but because you left before the feedback loop closed. What happens if you stay? Let's say you put 100K into Vanguard. You don't touch it, you don't add more, you just leave it. Year 1, you're at 107K. You made 7K. It feels like nothing. Year 5, you're at 140K. You made 40K. It's decent, but not life-changing. Year 10, you're at 196K. You made 96K. Now it's starting to feel real. Year 15, you're at 274K. You made 174K. This is where people wish they'd started sooner. Year 20, you're at 386K. You made 286K. This is where compounding becomes undeniable. But here's the catch. The first 5 years account for only 40K of growth. The next 15 years account for 246K. The bulk of your wealth comes from the part most people never reach because they quit in year 2, the real estate comparison. Now let's talk about real estate with the same honesty. You take that same 100K, you put 20% down on a $500,000 property. You rent it out. Year 1 feels great. You've got equity, you've got tenants, you've got cash flow. You feel like an investor. But here's what you're not accounting for: vacancy, repairs, property management, taxes, and insurance. Your actual cash flow is maybe $200 a month. That's $2,400 a year, less than the 7K your Vanguard account made. But it feels like more, because you're doing something, because it's tangible, because your friends are impressed. Fast forward 5 years. Your property is worth $580K. You've made $80K in equity, plus $12K in cash flow. Total gain, $92K. Your Vanguard account made $40K. Real estate wins, right? Not so fast. The hidden costs of real estate. What you're not counting is the time you spent managing tenants, the weekend you spent fixing a burst pipe, the $15,000 you spent on a new roof, the stress of dealing with a tenant who stopped paying, the opportunity cost of not being able to move cities because you're tied to a property. Real estate isn't passive, it's a second job. And if you account for your time, the returns start looking different. But more importantly, real estate has a ceiling. You can't easily scale from 1 property to 10 without leverage, risk, and time. Vanguard scales automatically. You add more money, it compounds, done. No tenants, no repairs, no phone calls. The real winner. So, which one builds more wealth? The one you don't quit. That's the answer. If you're the kind of person who needs short feedback loops, real estate might keep you in longer. If you're the kind of person who can tolerate silence, Vanguard will quietly outperform. But here's the truth most people don't want to hear. The best investors aren't the ones who picked the best asset. They're the ones who stayed invested long enough for it not to matter. Because after 20 years, the difference between 7% and 9% returns is nothing compared to the difference between staying invested and quitting. The new mental model. Stop thinking about investing as a strategy. Start thinking about it as endurance. Your job isn't to pick the perfect investment. Your job is to pick the investment you can stick with, the one that matches your psychology, the one that won't bore you into quitting, the one that won't stress you out to panic selling. That's the real edge, not intelligence, not timing, endurance. Reframing boredom. If your Vanguard account feels boring, that's not a bug, that's the feature. Boredom means it's working. It means you're not making emotional decisions. It means you're not gambling. It means the system is doing what it's supposed to do, compounding quietly in the background while you live your life. Real estate feels exciting because it demands attention, but attention is expensive. Every hour you spend managing a property is an hour you're not spending on your career, your health, your family, or another income stream. Vanguard frees up your attention. It automates wealth building, and that freedom is worth more than the extra 2% you might make in real estate. What to do now? If you've already chosen Vanguard, stop checking it. Set up automatic contributions. Delete the app from your phone. Check it once a year. Let the feedback loop close without you watching. If you've already chosen real estate, commit fully. Don't half-manage it. Don't let it bleed your time and energy. Either hire proper management or accept that this is now your second job. If you haven't chosen yet, ask yourself one question. Which mistake can I tolerate more? The mistake of earning slightly less while doing nothing, or the mistake of working harder for slightly more? There's no wrong answer, just the one that fits your wiring. The final truth. Wealth isn't built by the best decision. It's built by the decision you don't reverse, the investment you don't abandon, the strategy you don't question every time it gets boring. Most people lose not because they chose wrong. They lose because they kept choosing. They switched, they pivoted, they optimized, and every time they switched, they reset the compounding clock. The real skill isn't picking Vanguard or real estate. It's picking one and going silent for a decade. That's the edge. That's the missing factor. Patience isn't passive. It's the most active decision you'll ever make. Ending. If this reframed how you think about building wealth, leave a comment. Tell me which one you're committing to, not which one is better, which one you're actually going to stick with. And if you found this helpful, subscribe, because the next video breaks down the exact mistakes people make in year 3 that cost them 6 figures by year 10. The math is simple. Staying invested is hard, but now you know why.